So, you know, you sent over this article from the Motley Fool, and I gotta say, it's pretty timely. Everybody's worried about the economy these days.
For sure.
And what we're going to look at today is this dividend stock, Federal Realty Investment Trust, ticker symbol FRT, and how it's done when things get rough in the economy, slowdowns and such.
Yeah, sounds good. So just to be clear, the Motley Fool piece you sent over is dated March 15th, 2025. And what we really want to get out of this deep dive is how FRT has held up in the past, and especially their track record with dividends.
Okay.
We want you to come away from this with like a solid understanding of this company.
Yeah.
Could this be a steady investment, especially if we do hit some choppy waters, economically speaking?
Yeah, no, makes sense. So let's jump right in. The article kicks off talking about, what's on everyone's mind right now, the dreaded R word recession.
Yeah, exactly.
And what follows that naturally is companies feeling the pinch profits getting squeezed, and then what everyone hates, those dividend cuts.
Exactly. And those downturns can really throw a wrench in the gears.
Yeah.
Businesses struggle to just stay afloat, let alone, keep those dividends going, or even think about raising them.
And that's where FRT seems to be different right out of the gate. The article highlights this crazy streak they've got going, 57 years in a row with dividend growth.
Wow.
More than half a century. And when you think about it for the long haul, it's not just some number. It tells you something about how they do business and, how they're built to handle those economic shocks.
Yeah, it really is an impressive run. I mean, to put that in perspective, it's the longest streak of its kind in the whole REIT world, Real Estate Investment Trust.
Yeah.
And that consistency, it really says something about their fundamental strength.
And then the article brings up this really important point. FRT, they haven't just maintained their dividend. They've actually increased it during each of the last 4 recessions.
It's true.
Think about that for a second. 4 downturns, and each time they bump up that payout, gotta tell you, that's a pretty strong sign of resilience.
Oh, absolutely. It's not just luck. They're able to consistently raise those dividends, even when times are tough.
Yeah.
It makes you wonder, right? What's their secret?
Yeah, and that takes us right to their investment strategy, which the article boils down to this really simple idea, quality over quantity.
Yep.
I like that it's like a fundamental principle, right? They're not chasing after having like the most properties.
Right.
They're all about owning, managing, and developing what they call, mixed use properties and like high quality open air shopping centers.
Yeah, and that's key.
Yeah.
They've zeroed in on these properties in what they call first-ring suburbs.
Okay.
Places with lots of people and affluent consumers.
Oh, okay.
Across 9 big metro areas. And that's very deliberate. They're targeting a demographic that tends to be more stable financially, even when the economy is, taking a hit.
Makes sense. And the article gets into some specifics. Their portfolio's got 102 properties.
Yeah.
Clocking in at about 27 million square feet. Leased out to a whopping 3,500 commercial tenants. And they've also got about 3,100 residential units mixed into these properties.
Okay, so for context, they compare FRT to another big player in the retail REIT space, Kimco Realty.
Okay.
Their portfolio is way bigger, 586 properties over 101 million square feet. But what really sets FRT apart is that they've made this conscious choice to go for quality and strategic location over just sheer size.
Right. It's that focus on those prime spots with a customer base that's got a bit more financial security.
Exactly.
And the article suggests that this is a big reason why their properties tend to weather those recessions. People in those higher income areas, they might not cut back their spending as much even when the economy slows down.
Makes sense. And if we zoom out and look at the bigger picture, that means a steady stream of customers translates into reliable rental income, which is like the lifeblood of a REIT. That's what ultimately fuels those dividend payments you're interested in.
So then the article digs into how they've actually performed financially during those downturns, and it highlights this key metric for REITs funds from operations, or FO per share. Can you break down why FFO is so important for anyone who's maybe new to REIT investing?
Sure. So think of FFO as a REIT's version of cash flow. The money they're actually bringing in from their properties after covering the essentials.
Yeah.
It's often considered a more accurate gauge of a REIT's financial health than traditional net income because it factors back in depreciation, which is a non-cash expense that doesn't really reflect the actual ongoing profitability of their properties. So what's really striking is that FRT has more than doubled its FFO per share over the past 20 years. So, that doubling over 2 decades, which included some recessions, that directly impacts their ability to keep raising those dividends you're interested in.
And like the article points out, that 20-year period included two pretty significant recessions, and that chart they mentioned really shows that steady upward climb, doesn't it?
It does. And the article makes that comparison to Kimco Realty, again, noting that at the time the article was written, Kimco's FFO per share still hadn't bounced back completely from the 2008-2009 financial crisis.
Right.
But FRT's FFO per share was up over 130% since 2005. That difference is huge, and it really highlights how effective FRT's focused strategy has been.
No doubt about it. It really shows how those two approaches, FRT's focus on high-quality affluent markets versus Kimco's broader reach, can lead to very different outcomes when things get tough.
And it's not just about holding on to what they've got. Federal Realty is constantly working to improve the quality of their assets through a strategy they call high grading.
Okay, so let's break that down. What does high grading the portfolio actually look like?
So basically it means they're strategically selling off properties that they consider to be lower quality, or maybe they don't see as much growth potential there.
And then they take that money and reinvest it in acquiring or developing higher quality assets in more desirable locations. It's like they're constantly refining and improving their portfolio.
And the article gives a couple of really clear examples of this in action. One was the sale of their 3rd Street Promenade assets in Santa Monica for a cool $120 million. What did they do with that cash infusion?
So they took that money and, as the article explains, it helped them buy Virginia Gateway for $215 million. It's described as like this irreplaceable, really dominant retail center, which fits perfectly with their core strategy of owning those top-tier properties in strong markets. So they're essentially trading out of assets that might be less resilient and moving into ones with more long-term potential.
And it wasn't just Virginia Gateway, right? They also mentioned the acquisition of the Del Monte Shopping Center in Monterey, California.
It's exactly another prime example of them picking up a leading retail destination in a high-income regional market. These acquisitions really show their commitment to constantly strengthening the quality and future growth prospects of their properties.
So it's not just about their past performance. The article looks ahead to what's likely to drive their growth in the future, which obviously matters a lot for those continued dividend increases. They outline a few key areas, starting with those accretive acquisitions we just talked about. Can you unpack what accretive means in this context?
Sure. So when I say accretive, they mean acquisitions that are expected to immediately boost their FFO per share, which directly helps them maintain and grow that dividend. So Virginia Gateway and Del Monte Shopping Center are good examples of deals they expect to be accretive.
And then there's redevelopment and expansion projects, so they're not just buying existing properties, they're actively investing in and improving what they already own.
Right. The article talks about this residential development they've got going in New Jersey, which will add 45 new units plus some retail space at street level. This move to bring in residential elements adds another potential revenue stream and diversifies their holdings within those existing properties. They also highlight the redevelopment of the Andorra Shopping Center in Pennsylvania, which will bring in a new, larger grocery tenant and some other businesses.
And these aren't just shots in the dark. They're expecting these redevelopments and expansions to generate mid to high single-digit returns, so we can see how these projects will actually contribute to their future growth.
Absolutely. And finally, the article talks about organic income growth, which might sound a little jargony, but it's a fundamental part of their consistent performance. Essentially, it just means they're making more money from the properties they already have by keeping occupancy rates high and strategically increasing rents. It's a sign that there's strong demand for those locations, and the article suggests that this organic growth is expected to be in the low to mid-single digits.
So when we put it all together, the main takeaway from this deep dive into the Motley Fool article seems to be that Federal Realty Investment Trust's incredible history of constantly raising its dividend, even during tough economic times, it's not just some random luck. It's a result of a very deliberate and consistently executed strategy.
Exactly. Their unwavering commitment to owning top-notch real estate in affluent, densely populated areas, that's the core driver of their strong occupancy rates and increasing rental income. And this approach has been tested through multiple economic cycles, and it's allowed them to keep rewarding their investors with growing dividends no matter what the broader economy is doing.
So for you, our listener who sent this article, and the key insight is that FRT's dividend growth, even through those challenging economic periods, it's a direct result of a well-defined and consistently implemented strategy focused on owning high-quality properties in strong markets.
And, that raises an important question for you as you think about your own investment decision.
Yeah.
While FRT's past performance and, their clear strategy are definitely compelling factors. What else should you be looking at besides just this historical data when you're considering a dividend-paying stock for your own portfolio? Think about things like diversification across different sectors, your personal financial goals and your risk tolerance, and, other fundamental aspects of any company you're thinking about adding to your holdings. It's a complex decision with a lot of moving parts.
Absolutely. Lots to consider.
Yeah.
All right. Thanks for joining us on this deep dive.
It was a pleasure.
Until next time.
See ya.
This is The Deep Dive signing off.
Bye.
Bye.